Next, in this particular video recording, the last topic is the principles of lending. Any bank, the main objective is of the bank is profit with growth. Every bank, commercial bank means profit they have to earn every year. That is on 31st March. They have to earn some profit, and the growth should also be there. Year on year basis, the deposits, the advances, the profit, the number of customers, growth is should be there. But at the same time, the principles of lending. Once they have lending beyond the principles, then if the loan is turned into bad, then it will be turned into non-performing asset. Once it is a non-performing asset means they are not paying the loan timely. Once it is not paid timely, then the problems will start. As per the Reserve Bank of India guidelines, the interest not to be calculated if the loan installment not paid on due date, and the bank will wait for 90 days. Up to after 90 days, the interest not to be applied. Thereby the revenue of the bank will reduce, because once interest is debited, then it will be credited to the profit and loss account. So that's why the principles of lending, the safety of the advance is required. Once the safety, liquidity, what is the liquidity? Whenever the bank is raised the demand, they have to pay. That liquidity, profitability. Once the banks are giving loan and they are borrowed funds from the public by way of deposits, those deposits are given to the borrowers, then the interest difference is called profit. Once the loan is turned into bad, the profit will not get it. So that's why the liquidity, the profitability, safety of advance is also required. That is lending. But whenever the banks are giving a loan to the public, they are verifying either 3 C's or 5 C's. This is from the good olden days to till date. Good olden days to till date. What is the 3 C's? What is the 5 C's? The 3 C's are the character of the capital, the capacity of the lenders decide to lend you. Whenever the lender is lent to you as a borrower, your character will be decided, not this one. Once the banks will verify your character, if at all this borrower is taken any loan from any bank and defaulted or not. That's why the best verification is the CIBIL score, Credit Information Bureau of India Limited. Through that, if at all is taken loan and promptly paid, the score will be more. If at all not promptly paid, the score will reduce. The capital. For every business, his own contribution is required. That is capital. Suppose one car is required by the borrower, and he told that 40% I will contribute, sir. Remaining 60 only bank will give the loan. Then bank safe. Bank is safe. Why? Because once the asset is created, the total asset is in the bank's charge, either hypothecation or the mortgage, etc. So once the charge is created in the favor of bank, so 40% borrower's stake on the asset, bank loan is 60. Sufficient margin is there. The capital, own capital. In any business, own capital is required. They should not completely depend on 100% loan from the bank. Their contribution, their capital is also required. That's why the banks are also verifying the debt equity ratio. How much equity the borrower is having, how much debt is borrowing, that also they will. That's why debt equity ratio is one of them. The capacity based on which the lender decided, the capacity, whether he is able to pay the loan or not, how he will able to pay the loan. Once the income is generated, then only he will pay. Once the project who is is going to handle whether income is generated or not. The credit officer has to the credit officer has to verify whether the revenue will be generated on account of taking the loan and on account of operating the business. Then all the banks will give. Otherwise, the banks will not give once the capacity of the borrower is not there. In the similar manner, the 5 C's also defined by either 3 C's or 5 C's. The three are common. Three are common. When a loan application, lender used 5 C's of the credit to evaluate the loan proposal. What are the 5 C's? The character of the borrower, the capacity of the borrower, the capital of the borrower, the conditions of the loan of the borrower, the collateral security offered by the borrower. That's why the 3 C's or 5 C's that is a must while evaluating the loan proposal. If at all you are going to join as a credit officer, definitely these are the principles of the lending, the safety nets of the advance, the safety net of the. So the 5 C's are the character, the capital, capacity, the capital, the conditions of the loan, and the collateral security. All these things have to be taken into consideration. The capacity. What is the capacity of the borrower? Like most of the important of the 5, capacity of your business able to repay the loan. If at all the amount is generated, there is no problem to repay. Suppose the bank has fixed the 5 lakhs per month installment. If the company has generated revenue 10 lakhs, 5 lakhs is not a problem. That's why the specifically lenders look into revenue, expenses, and cash flow for repayment of the timing, and will look into the business and personal credit scores. That's why the banks are always thinking about the capacity to repay. Suppose one person is there, he is not having any loan, any income, but he is asking a loan, but he is offered a security also. But once security is there, no problem to the bank. But capacity is also required. Otherwise, if he is not paid, then the loan will turn into bad after 90 days from the date of due date of the loan. Capital. The cash you put it towards the starting of the business called capital, and it go way show the lender how serious about the success. Because some of the borrowers, their own capital is not there. They want to run the business based on the bank's funds. That is not correct. Banks will also verify whether he is capable of having some amount, own amount or not. Once the own amount is there, then there is no problem to the bank. So the capital is very important. The capacity of the borrower is also important. In addition to this, the collateral. Once the banks they are giving loans, they will always insisting security. The primary security and the collateral security. There are two types of securities are there. One is the primary security, second one is the collateral security. What is the primary security? The loan which is given for acquiring the asset is called primary security. Suppose I take for example, one business unit is there. He wants a loan for purchasing of raw material. Raw material is the primary security to the bank. Once the loan is not paid, then the bank will ask at the time of giving the loan. Okay, primary security is there. Okay, if at all primary security you have used and run away, there is a security. That's why the bank and the borrower will give collateral security. That is a house or land or building they will give. And sometimes government security, sometimes gold also he will give, or the LIC policy or a national savings certificate, etc. That's why the collateral security the banks will insist for safety of the advance. Safety of the advance. When evaluating the loan application, the lender will generally look at a collateral security and a secondary source of repayment for the loan. If at all the primary security is used by the borrower, and bank will sell the collateral security and appropriate that amount to the loan amount. They wanted to make sure that loan payments are stopped the reason and they can recover they were owned through collateral security. This could be equipment, collateral security, maybe equipment, maybe vehicles, maybe inventory also. The loan amount will be based on the percentage of collateral security. How much nowadays the banks are also used one terminology that is called LTV, loan to value. Loan to value means if at all I have given 100 rupees, the loan, what is the collateral security value? So different types of collateral security they are taking and it differs from product to product. There is no benchmark for this. So the loan to value, conditions of the loan. Once the loan is given, for particularly the housing loan, bank will ask EMI, equated monthly installment. Every month you have to pay this much amount like that. And if at all the banks are giving for business purpose, you have to submit the stock statement. And every year you have to renew the loan account like that. So that's why the conditions, whatever the rate of interest, we will apply like this. And the rate of interest is a quarterly compound or monthly compound like that. So now the banks are applying interest on monthly. So to demonstrate there is a market of a business and a clear for the purpose of loan based on the local, regional and national economy and the competitiveness of the business and industry experience and experience of the manager. So the conditions, whenever they are giving loan, the conditions will stipulate. Nowadays, the competition in the banking industry increase. That is, the rate of interest is one of the area. And the processing charges, sometimes they are waiving also. So the conditions of the loan, whenever the loan is sanctioned by the bank, the conditions are stipulated. These conditions are to be agreed by the borrower, and if at all any guarantee is there for the guarantor also, he has to agree, and they have to sign on the conditions of the loan. That's why that paper is called terms and conditions of the loan. Terms and conditions of the loan, that is to be signed by both borrower. If any guarantor is there, need not be all accounts are need not be guarantor, but in some cases guarantor is there, he has to sign and bank will also sign on that. That is called terms and conditions letter. In some banks it is called arrangement letter also. This is stipulated by the bank, the borrower has to agree. That's a condition. The last one is the character, the character of the borrower. Finally, the C include a look into whether the borrower including what is the educational qualification, whether he is competent to run the business, whether he is getting any income or not, going to get any income or not, business experience, personal credit history, that is a CIBIL. And personal credit history is important because you may have required personal guarantee to the loan. And the statistics show that the person who is handles the personal credit generally indicate he or she manages the business credit. Any references or background information you can provide. Sometimes in the market also, some other people are insolvent. Then the bank will not give any loan to them. So here the experience in the line of activity, that also we will take. Suppose one borrower is there, he is giving adequate security and he wants to start a good business, but the borrower is not having experience. So basically he should have some experience. Others they may assist, that is a different issue. But here the basically he should have the experience, and whatever the experience is their background, qualification. If at all he started a chemical industry but he is not having any knowledge about the chemical industry, then so the character means not only the score, whether he is repaying the repaying the earlier loans to the banks is in time or not, what is his education, what is his experience, and the background information from the market. That's why whenever the banks are giving, they will inquire the background checking through the market. Because nowadays it is a wider market, it is not possible, but particularly the companies and all these things through media, the paper, all these things they will take into account. MCQs. The primary relationship between the banker and the customer is at the time when the customer opens an account. The relationship between the banker and the customer starts with opening account, whether it is a deposit account or loan account. The relationship starts once the account is open. The typical commercial banks provide a short-term loan. Why banks are called money market? Because the maximum period of deposit is 10 years. The maximum period is, but nowadays banks are also providing 15 years housing loan, 20 years housing loan, maximum 30 years housing loan is also there. But they will manage the funds through asset liabilities management. They are managing the funds through asset liabilities management. So the short-term loans only the banks are preferring. Earlier, term loans are all India financial institutions and state financial corporation they used to give earlier. Now the banks are giving not only the short-term loans but also the term loans. But the basically their funds are savings bank, current account, and fixed deposit only short term. But if it are any refinance facilities there, they will go for that term loans also. When the customer account is overdrawn, then savings bank account is there. Savings bank account should be in credit balance, but loan they overdrawn. Overdrawn means the customer will become the debtor to the bank, and the for the customer bank is the bank is the creditor. So debtor and the creditor relationship. And who controls the credit in India? Credit in India, even though banks are pumping the loans and advances by way of sanctioning loans and advances to the public, that is called credit. This is also regulated by the Reserve Bank of India. Why? Because too much pumping of credit in the economy leads to inflation. Money supply will increase. Once money supply increases, the value of the money will come down. So that's why to control the credit, one tool is used by the Reserve Bank of India that is called monetary policy. Monetary policy. Monetary policy through SLR, CRR, repo rate, reverse repo rate, bank rate, open market operations, liquidity adjustment facility. So, number of tools are devised from time to time. That's why to control the credit in the through the banks, the Reserve Bank of India using monetary policy. So, who controls the credit in India? The Reserve Bank of India. And in respect of regional banks, the shareholding is not completely owned by them. The share capital, 50% is a central government share capital, and 15% is a state government where the RRB is located, and a sponsoring bank. Almost all the banks are, RRBs are sponsored by the public sector banks only. So each public sector bank, they will sponsor that the sponsoring bank 35%. So central government 50, state government 15, sponsoring bank 35. That is the shareholder pattern of the regional rural banks. This is in brief about the video recording one. And on behalf of Oliveboard, I wish you all the best in your examination. Thank you very much.